what I see in terms of the changes of the market right now is, essentially there's three phases of the market for us. One of the phases is balance sheet repair. And this is when companies are over-levered, commodity prices have typically dropped, and they're not generating as much cash flow, and their debt starts catching up to them. And so we call it the balance sheet repair phase, which we feel we're just coming out of. That's the situation we've seen for the last 3 or 4 years. When we come out of that, usually it's because of a strengthening market, which we have seen. There's some, especially the base metal prices have definitely recovered a bit from their lows. Even precious metals are up slightly, and there's a stronger sense of optimism on the precious metal side. And so that's the time that we start feeding into project development, supplying funding for new builds or for expansion projects, or even supplying capital for acquisitions and putting companies together. But the growth phase versus the recovery phase. Of course, the third phase is when we sit back and reap the benefits, and I call that the high point of the cycle. And so my hopes are, what I see right now is that we're leaving the sort of the balance sheet repair phase, moving into the growth phase, stronger commodity prices, and so we still see some opportunities coming into that space in terms of continuing to grow. It's been good because we haven't seen a lot of, since Constancia has come on stream, we haven't seen a lot of development opportunities out there. But ultimately, we see precious metal prices continuing to move up, base metal prices strengthening, and looking for the development opportunities right now. Benefits of a diversified portfolio for all the challenges that we've had at San Dimas, they've been more than made up from positives at other assets like Salobo and Antamina. So San Dimas was the first asset that we invested into, and built our company around. We've had it since 2004. Primero's got some challenges; they're pretty well documented. We're working with Primero to try and get through these challenges. But any shortfalls on that side have been made up by benefits at Salobo and Antamina, and Constancia continues to perform well, and it's the benefits of having a diversified portfolio, and the fact that San Dimas, which was our first acquisition, our first stream, is now third or fourth largest in our company. It doesn't have as much impact on our company as one would expect. I think that the smaller companies have had a bit of a tougher time getting going. They're still not getting the support on the equity market that they deserve or think they deserve. And so we're still seeing a good, healthy appetite for streaming as a source of capital down in that range. And so most of those transactions, they fall anywhere between 100 and 400 million. There's a lot of competition in that space. There's a lot of new players that are trying to come into that space, and so it's one that we watch. I think one of the opportunity sets that we may see over the next while is some consolidation in the space. We're seeing some transactions that are pretty well priced, and maybe perhaps even overpriced. And when companies start making mistakes like that, it always opens up opportunities for consolidation also. When I look at the American dollar and what it's trading at, I think it's overvalued. The challenge is, of course, there's no other currencies. The euro continues to collapse. I just don't think it's going to survive long term, and so it's pretty well the only currency out there. China's not going to be competitive and such, and our challenge is, or our strength right now, is the fact that we have performed so well in the face of a strong American dollar, because we are measuring our gold and silver in U.S. dollars. But boy, the first little hiccup in that U.S. dollar, and that's when we'll see a real spike in precious metal prices as a store of value and a good liquid, safe place to keep your savings, right? Your value. And so it's there's a bit of a honeymoon going on down there right now, and I just don't know how sustainable that honeymoon is. It's pretty clear when you compare our business model to that of the mining companies. Our costs are fixed, and that's one of the biggest variables, and it's actually one of the biggest things where the mining industry has continually failed to deliver on is decent costs and decent capital costs and operating costs. And so it's it's a key factor that makes our model attractive from a resource investing perspective. Where I really like to compare us to is the ETF or bullion holdings, where we deliver so much more. We deliver leverage, we deliver growth, organic growth, and accretive, attractive acquisitions that build assets going forward. And when you add that all up, it actually delivers so much more than an ETF or bullion. And then you sit in or bullion holdings, and you sit and look at the management fees that we pay. We're about 29 basis points in terms of our G&A if you apply it over top of our share price. We're 29 basis points, and we pay a dividend. So to be honest, we pay you to own our shares versus where you do pull bullion and ETF holdings. Absolutely zero growth, zero leverage. We will always outperform, and you have to pay outright for those holdings. And so we think that that's an area that people should understand. Our risk profile is much lower than a traditional resource company, a traditional mining company. Our costs are fixed and very predictable. Our asset base is one of the highest quality asset bases in the world. We provide leverage, we provide growth. That's where I think our stock looks undervalued, is when you compare it to the two costs of just owning gold or silver in an ETF or owning it in bullion. We deliver so much more, and so that's an area that we think we can continue to bring in shareholders.